Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey Kirk, happy Friday to you. And for those of you all over the country, don't slip and slide if you're in the south, and if you're in the north, don't freeze to death. So,
Yeah, it's going to be, we're going to get a foot of snow on Sunday, which is going to be great.
-20 this morning in Minneapolis. They said the coldest place in America. I'm sorry, in the world today will be Ontario. Of course, that means nothing because Ontario is huge, and so is that north of me or is that over by Toronto? Big difference. But they said it could be up to like something like -57 temperature in certain parts.
Wow.
Hey, enjoy.
Yeah.
And what get you know what? It's a good segue. It just means the world needs more energy.
You would think, Doug, but let's not take that energy road, and let's kneecap ourselves and try to make it a lot harder to get energy by going for the least efficient energy sources and that require batteries, which we don't have. Let's do that. Wouldn't that be a good idea, Doug?
Kirk, that methodology is changing now that they need data centers. So the good news is that everybody's getting on board for energy these days.
Yeah,
All of a sudden.
You know why? Because the tech bros need it. If the tech bros need it, it gets done. All of a sudden, climate change has disappeared. We're not talking about that anymore. Apparently, that's not an existential threat. And all of a sudden, all the the regulations and all the stuff and all the salmon in the rivers, it doesn't matter anymore, Doug, because we need energy and the tech bros want it. We're going to get it. I have to say, we'll move on from this because it's going to get.
I'm going to say this one quick thing because I think it's really funny. Is last year they actually were surprised that the polar ice sheets actually expanded. They're like, we don't know how. Of course, we're talking about -56 in Ontario today. But the rhetoric that I heard this morning was, let's ignore that and look at the fact that it's 100 degrees down in Australia. So,
well, it's probably just because they actually measured it properly instead of trying to kick the, trying to nudge the numbers wherever they wanted them to go. It's kind of like, expect them to be accurate. You mean the government has accurate numbers? Yeah, I trust any number. We had this on the show, I think about a month ago. We said, don't trust the numbers. There's a reason for that. You can't trust any numbers. Not only because first of all, you can't trust government numbers because they're almost never accurate. You can look at the revisions to tell it's not accurate, but even then, even big data numbers from Microsoft, numbers from Philip Morris, whatever, you can't rely on these things as fact. The best you can do is say maybe they're directionally accurate, but you don't know that for a fact. Everybody games the numbers. So, what does that mean? Well, you have to find other ways to navigate the field if the numbers are being gamed. So I'm not going to get down this track because I wanted to talk about something today, which is what we're deeming it the run it hot economy. We talked about it last week, but I put together kind of a little outline for everyone so we can start really talking about it and get a feel for what this is. And for those of you who are listening, forgive my midnight DJ voice here. Midnight jazz had a little bug this week, some sound a little extra deep, but I wanted to
saw some feedback and data that said that he needed to be more sultry to get more out of it.
Need that sexy voice of midnight jazz, Doug. All right. All right, so let's kind of talk this through the framework because we're still at the early stages of this, but I suspect this is the way it's going to go, and if it is, then we're going to be leaning on this framework a lot. So you really need to understand it if you want to make a lot of money. I could tell you that if you've been using this framework in the last month, you've been doing very well. I'm looking at my accounts thinking, should I just sell it all and just pack up and take a vacation for the next 11 months? Because God damn, this has been a weird year. It's in a good way. But all right, so let's talk this through. And I'm going to walk through the thesis and I'm going to walk through why. Because you always need to know why. We never know the real reason, but if you have enough of the evidence, it points in a similar direction. So let's start with Trump. Okay, Trump is in his second year, starting his second year, and we have the midterms in the fall. Now, when the midterms come around, typically when you have a president in their second year and the midterms come around, typically it switches, right? If both parties have control, if the same party has control of both parts of the government, then typically they will swap, and so there'll be a split in the second part. That's very common, right? So it wouldn't be uncommon for it to happen this time in November. However, Trump, being the person that he is, doesn't want to, he's got a lot he wants to accomplish. He had one term, 8 years ago that he basically didn't get much accomplished because the Democrats just, stymied him the whole way, and all the shenanigans they were pulling. He didn't get enough accomplished. Now you can tell this time in the last 12 months, he's getting shit done. Like, you might not like what he's getting done. That's not my point. My point is he's getting shit done. You can't knock the guy. The guy's, however old he is, 70 something. He probably should be retired by now, but he's in there. He's getting shit done more than any president I can recall. So he wants to keep getting shit done. He's got a lot on his plate, and I can tell he's got a lot that he wants to accomplish. So here's the thing. He needs to retain control in the midterms if he wants another 2 years where he can get shit done. So how is he going to make that happen? Well, if you think about the economy right now, we have the economy as what we're calling a K-shaped economy. We didn't come up with it, but a lot of people call it that, where you have the rich are getting richer and the poor are getting poorer. The rich are getting richer because asset prices are going up. Poor are getting poorer because expenses are going up and their wages are not. That's the K-shaped economy. So how does Trump flip that so he makes everybody happy? Well, he's got to keep the rich getting richer because everyone's rich, including himself. So, hey, how do you do that? You keep the asset prices going up. How do you help the poor? Well, the easiest way is to make sure that the gas prices go down. Lower travel costs, lower your gas prices. That would be a good thing to do. How about lowering housing prices? That would also be a good thing to do, right? You lower housing and you've got, rent and mortgages and all that. Well, that helps, right? Lowering inflation, the cost of goods and services, that helps. Stock market's going up. And my last piece is basically making people feeling good about themselves, making them feel good to be an American, right? Or at least the people who voted for him, right? Because the other people aren't. But the people who voted for him, he wants to make them proud to be Americans. So he's trying to do things to make people proud of being an American, which makes them want to vote for him for doing that stuff. Like, those are the things that he needs to do. There might be some more, but he definitely needs to do those things. He needs to come through in his promises, which he is in many ways. If you voted for him for something, he's most likely already accomplished that thing. He's done a lot in the last year. So I imagine in the next 10 months, he's also going to do quite a bit more. So keep that in mind. Like I said, doesn't mean you have to like what he's doing, but he's getting stuff done. He's accomplishing his wish list of what he's actually said he's going to do. So I give him credit for the fact that he's doing things he's laid out to do. I don't like a lot of things he's doing, but that's not the point, right? We're not talking about whether we like the guy or not. We're talking about what he's getting done. So if that's the wish list, then what are some solutions? Well, here are some solutions he could have to solve this. Have an accommodative monetary policy, i.e. lower rates plus QE plus overspending, and not balancing the budget, but overspending, just like we always done. The big beautiful bill, and whatever else they're gonna kick in there. Lower oil prices. We've already started to do that. What happens when you lower oil prices? Corporate earnings go up, right? Because all the trucking and stuff that goes into transportation, the cost of that go down. So lower oil prices equal higher corporate earnings, which means your stocks go up, which means corporate profits go up for people and companies. It helps small and mid-sized companies, especially. What else going on here? And then, and it should accelerate the growth of GDP. So the interesting thing is, if you look at what if we look at the run it hot economy, what that means is basically GDP is going to increase. It's going to be a lot higher than we're accustomed to. We're accustomed to like 2%, 2 and change. I could see it going up to 4 to 5%. Okay, maybe even higher. I also see inflation staying high. I don't see inflation going back down to low rates. I think it's going to stay relatively high. And what that leads to is a time we call an inflationary boom. Okay, an inflationary boom is the best things during that are commodities, stores of value, real estate, cyclical producers. You don't want to own long-term bonds in that environment. But during those times, you had like the late 90s. The late 90s, everything went up except for gold, but everything else went up. Actually, let me reframe that. It's not a perfect correlation because late 90s, everything went up except for commodities. Commodities didn't do as well. But there are times where if you look at like the 70s, right, the inflationary bust, this would be another part of that. The inflationary bust is when you have high inflation and low GDP or flat GDP is what we call stagflation. That's when commodity prices went through the roof. That's when bonds lost a lot of money. That's when companies didn't do well. The stock market actually did well initially, but then it tanked and did really poorly for a while, and then it came back. So I wouldn't be surprised to see stock market do well and then do poorly if we don't get the growth, right? If you have high inflation, you don't get the growth. So, we have this situation where it makes sense to own commodities right now, and if you've owned them, like we've been talking about for the last year, you've done very well for yourself, and congratulations. It's been a banner year, and it's still going, so pretty happy about that. But it's not going to last forever, and castles aren't built to this. Don't go to the sky. I probably screwed up that metaphor, but things don't last forever. Okay, so just because all these commodities are going up, that's great and it feels good, but just know that at some point that turns around. Just like with crypto, it goes straight up and then it goes down. Like you just have to keep in mind that these things don't necessarily go to the moon. They do. There is a downside to that. You just have to be aware of it. So, all right. So we talked about last week the inflationary bust, the inflationary boom, the disinflationary bust, and the disinflationary boom. So the inflationary bust was the late 70s, high inflation, low growth. Inflationary boom, late 90s, high inflation, high growth. Disinflationary bust is Japan from 1990 to right around 2023, or the Great Depression. This is when effectively low inflation, low economic activity. And then you have the disinflationary boom, which is pretty much 2010 to 2022. This is when you had low inflation and good growth. Things that do well in that were like tech companies, innovation, companies with pricing power. So if you look back, and there's these different parts of different quadrants of the visual we showed last week, and I'll share it in a minute. Depending on growth and depending on inflation, you're going to get one of these cycles, and you want to make sure you're investing according to that quadrant, because that's where you're going to do well. So let's kind of go through some other things, and I'll hand off to Doug to talk about. So what do we have right now? Higher inflation, certainly higher than 5 years ago. Fiscal deficit is increasing. Sovereign debt is hitting escape velocity, right? We've seen that. It's not going to stop. I know Trump's talked about, Doge, and in some ways, the Doge trend, I mean, technically, I'm not sure if Doge is still doing anything, but the trend of that is actually could be interesting. If these states are committing fraud and we get some of that money back, that could be interesting. I don't know if that's going to move the needle, but if we have a lot of fraud in the government, that could also save us money. I'm not sure how much fraud there is, but I'm willing to bet it's between 20 and 30% of whatever we're spending, at least. So, all right, you also have expensive stocks, you have tariffs, and you have unpredictable government policy. That's what you have right now. So the question you have to ask is, what problems are we trying to solve? Well, we're trying to solve the problem of the debt crisis. We're trying to stat a recession. Trump wants to retain Republican control in the midterms and accomplish global goals, like taking Greenland, for instance. So if you're looking at the chessboard here of what's happening, and that's what we're trying to do in this conversation here, is look at the chessboard. How do you solve these problems? Well, we have too much debt, and we're spending too much money, and that's not going to stop. And, you know, I know there are people listening here who think, you know, that we need to get rid of the Fed. We need to reduce, you know, Trump needs to reduce the debt, he needs to reduce expenses. I agree in theory with all of that. However, what you need to think about is practically is what would I do if I were in their shoes, right? So let's take end the Fed. I'm totally on board with that. I think the Fed is not doing a great job, and if anything, it's basically just an old boys club that they're helping each other out. Okay, there are some benefits to it, but in large part, they're doing more harm than good. However, even though I believe that we shouldn't have a Fed, how do you transition from where we are now to no Fed? It would be a catastrophic change. It would not be an easy transition. You can't just say, "Oh, well, we just get rid of them." Oh, okay. Who's going to be in charge? The president? Like, that's not a good idea. So I don't know what and I'm just saying, I don't know what the answer is to what the solution would be to like ending the Fed. But you need to understand that there is a transitional period between what we have now and where we want to be. And that's really messy typically because it's already involved in our infrastructure quite a bit. So if you look at a lot of debt, if you look at what happened with Doge and you got all these government expenses, everyone starts crying foul when you come after their money, right? And a lot of people depend on the government, and a lot of businesses depend on the government. Like, it's an interconnected thing. It's not a simple, you know, just cut the cord and like see you later, just get rid of all this debt. So what the government has effectively done over time is if you have too much debt, you can handle it in one of a handful of ways. First way is through inflation, right? Inflation is what you try to do is you try to have inflation that is higher than the debt that's increasing, right? So you have a certain amount of debt that you can have, and then if it goes up, let's say 5% a year, you want to have at least 5% inflation, but ideally more than 5 because the inflation will devalue the debt. So so if you look at the 70s, we had inflation upwards of like 20%. You had like 30-year bonds at like 20% at one point. So if you have really high inflation, that debt just disappears really quickly because you just devalued it by 20% in a year. So inflation is a way to inflate away the value of the debt. Hard to do, but certainly possible. Another thing you can do is you can grow your way out of it, right? So the debt is always balanced. The income and expense are always balanced, right? Just like your own checkbook. So if you have higher expenses, you need to make more money, right? So it balances it out. If you make more money, you can spend more, right? So you can do more. It doesn't mean you have to. So the way that the government does is the same way. So they have a lot of debt. So what's the way to handle that, right? Because the interest expense keeps increasing. Well, the way you handle it is you increase the GDP. So you have more taxes can pay down the debt. So that is another way to do is grow your way out of it. Okay. A third way would be to default on the debt and just say, screw you guys, I'm going home and I'm not paying the debt. Right. And, you know, that would be catastrophic for so many different reasons. And that is the worst thing you could do because no one would ever trust us again, or at least for another 50 years. You couldn't borrow money from anybody. And on top of that, we wouldn't be the global reserve currency and would destroy our economy. So pensions, 401ks, all zero if they default on the debt. So it's a problem, right? So you can't do that. And then the last one is revaluing assets, i.e. gold. Now, this was done before. It was done a few times, actually. It was done when they confiscated gold in the 30s, when they came in and said, hey, we need your gold. And they confiscated it, and then they revalued it. I forget what it was. It was like $20, and they revalued it to $35. But they revalued it. Okay, that's a way of not defaulting, but that's a way of causing inflation because you're causing your assets to go up way more than the expenses. They also did it in the 70s when Nixon closed the gold window. And so when you look at the valuations, what you're trying to do is you're trying to, so let's say gold, which is kind of happening right now. Let's say they decided we're going to revalue gold tomorrow at $20,000 as an example. Well, immediately our balance sheet looks great because we're valuing gold at like whatever it is, $50 an ounce. Well, it's really $20,000 an ounce. So all of a sudden we have a lot of assets we can use to pay down our debt, and our balance sheet doesn't look so bad. And I'm not saying it looks great, but it's something that can be done if people wanted to do it that way. Okay, it's just a methodology. So those are really some of the solutions. So if you think of the solutions that they've done in the past, it's been, hey, let's cause inflation. Let's cause inflation and inflates away the debt. Okay, that's fine in a normal environment. You can't do that right now because there's too much debt and inflation's high, but it's not high enough. So, and we're spending way too much and we can't control it. So the only other thing you can do is you can grow your way out of it. So high inflation and high growth leads to two things that are basically exponentially helping us with the debt. So growing the economy increases the income, and then you have inflation, which is decreasing the debt. So it's causing it to balance by shifting both levers. And that will help with the expenses. Now, it doesn't solve the problem of we can't control ourselves like a drunken sailor with our expenses as a government. That needs to be solved. But this solution can solve other big problems. So when we think about the run it hot economy, nobody's said this. This is kind of our naming that we came up with, but I'm seeing that this is the way things are going to go. Yeah, I've been doing this long enough to see the writing on the wall. Commodities have been out of favor pretty much my whole career, and the fact that they're in favor tells me that this is the way things are going. So you should see the writing on the wall. Like commodities are generally not the kind of thing that skyrockets like they are. And you see copper and you see gold and silver and uranium and all these commodities going through the roof, metals primarily. It means something's happening. It's not because, oh, I wonder what's going on. No, there's something driving that. And so we're going to talk more about the run and hot economy as we go, but I wanted to at least lay out the framework for everybody so you understand where we're coming from, why we're talking about things like this. You know, it started last year with gold and silver. I thought that was a little bit different of a reason that started to take off, but once gold took off, then silver, and then you had copper, and then aluminum and steel and all that. So I expect that trend's going to continue, and we'll see where it goes. But we have a lot of moving chess pieces on the global board with Greenland and Europe and Venezuela. There's a lot of stuff moving around. So between now and the next 10 months, I imagine the world will look like a different place. But the best thing you can do is to pay attention to this. So you know how to invest. Don't ignore commodities just because they haven't done well in the last 20 years. And you want to stick with big tech because that has done well. The chessboard is moving. And what things that don't do well in this run and hot economy are big tech, innovative assets. They don't do well in this kind of economy. I'm not saying they won't do well. I'm saying they don't typically do well. And since they're overvalued anyway, you might want to reallocate your portfolio a little bit to favor other areas that are doing well and maybe, lessen the favor of big tech, which if you've been in it has done very well for you. But the board, things are changing and you want to make sure that you're aware of that and you're not just, clicking the same button over and over again because it worked for you in the past, because it's not going to work for you in the future. So
is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
Anyway, what are your thoughts on all this, Doug?
Well, the last thing you just said, I think, is really, really important. I mean, it's very commonplace to stick with what's been working, and we talked about this a couple weeks ago. There is some risk of trimming stuff that's been working. One of the biggest issues sometimes is regret of traditional rebalance and cutting out the things that are actually have the momentum, because sometimes that momentum might continue on for years. And we saw that with big tech, and we saw that with emerging markets in the 90s, and where if we just trimmed and got out of it, your actual overall return ended up being significantly worse than it could have been. And also, talking again on that note, S&P 500, which right now, the chart that we talked about a week or two ago, only about 44 stocks were really determining the growth and direction of the S&P 500. But when it really comes down to it, only about 40% of them, as we all mostly know, it's generally going to be the Magnificent Seven and a handful of others are really where it's all at. And a lot of that is big tech. And so it's, there's two sides of it, right? There's keeping along the same path of doing what's been doing well and just doing it for doing its sake, right? Because that's been working. There's also cutting it early and ending up in a scenario in which you've cut out of something that's that could have continued to work for you. So the balance here is actually doing your research, knowing what needs to be done, and really looking at the bottom line. You don't just get out of tech or the S&P 500 because you think, hey, it's expensive and now it's time to get away. You got to look at underlying forces that are going to either work as tailwinds or headwinds. And what you're saying here is, and what we're saying here is, we are coming into a situation in which there's a changing of wind. We're looking at basically this direction where what was headwinds or tailwinds for certain things are now going to become headwinds. And now is when you need to consider that adjustment. I mean, if we had said to jump into silver and gold 3-4 years ago, well, there was no forces creating tailwinds for those at the time to the degree that they are now. That would not have been the right time to necessarily just roll into those things because they were cheap, nor would it have been a good time to get out of big tech because it was expensive, right? But so there's a lot more data that needs to go into this. And again, why were we saying 6-8 months ago precious metals was a good time to get into it? Because the forces change. And we've seen some people that have really listened to that and done very well. Not that we had a crystal ball, but because there was these elements that indicated now was a time in which that was going to be better. So getting into things a little bit more granular, in terms of things you talked about, I want to start with the fiscal and sovereign debt. There's a big difference between the two. I mean, fiscal debt is structural. It's not cyclical. Sovereign debt functions on confidence, not solvency, right? So governments, are implicitly choosing inflation over austerity because inflation is actually survivable politically. Inflation management, running it in modestly hot. It's, on the positive side, it reduces real debt burden. It avoids explicit cuts. It preserves nominal growth. But on the con, it punishes savers. It can break fixed income assumptions. And the repercussions of it can force households into more and more risk assets. And you can lose and erode trust over time. You talked about, just defaulting on debt. This is one of the things you're hearing out there as well. How is Europe going to counter some of the rhetoric, if they're upset with America? Well, it sounds really good as a political talking point. We're just going to sell off those U.S. bonds. But the reality is they are very embedded in our government debt. And if they just were to do that, it's a self-fulfilling prophecy of disaster for them. I mean, European pension plans are built on the investment in U.S. government debt. Just sounds great to get rid of us. It isn't going to happen that easily. Now, it could systematically over time deleverage that. It's going to take a long time to do it. So, the financial repercussion of rates below inflation is you're going to have lower debt service costs, stabilized bond market short term. Longer term, though, distorting capital markets, penalizing conservative investors. You can run into asset bubbles, mispricing of risk. Tax expansion is another area they could look at. And this is the one that likes to get a lot of talk. It's predictable revenue. You know exactly what's going to come in, potentially, right? Because obviously, if it's expensive and there's tax issues at play, you might see if the economy unwinds, the taxes go down. But it's politically survival. It sounds great. But the reality is it creates middle class squeeze. You get reduced consumption, and that can eventually lead to slower growth and social resentment. So another area they could look at is spending constraint. Wonderful, great. Let's just cut all those costs, and that does potentially improve long-term sustainability. But and it can also signal discipline to the markets. But at the other end, it's politically dangerous, right? You're pulling stuff out that does inject capital into the markets, and that creates short-term pain. And again, if you're looking ahead at things like midterm elections, that could be a political disaster. So all of a sudden, you end up with electoral backlash. You end up with policy reversals. And the bottom line is debt is managed through dilution in time, not repayment. Now I jump into inflation. There's headline versus real needs inflation, right? Because everybody's inflation's cheaper now. It's cooling on the headlines. But needs inflation, like housing, insurance, healthcare, tuition, utilities, that remains elevated and potentially very destructive. You've got what are some options there? Wage growth tolerance. It can preserve household stability. It can reduce unrest. But at the same time, you could have secondary inflation, compress margins, end up with inflation persistence and lower productivity growth. So what about subsidies? What about credits? There's another area. Well, again, those can lead to immediate relief, politically popular, but they can expand the deficits even further. They can distort pricing signals. And now the inflation can become hidden, but not solved. So now you look at supply side, demand side. So supply side reform, that can be long-term price relief. You can have structural improvement, but it can be very slow. And again, politically complex, which doesn't allow it to really ever settle in because you have political turnover and people want to get reelected. So the repercussions is you get short-term pain before the benefit, and that's never good politically. What about asset inflation tolerance? That's something that's great for balance sheets. It stabilizes markets, but then you get the headlines of widened inequality. You get social tension. And at the bottom line of all of these is essentials inflation is redistributed, but it's not eliminated. Now we go into, okay, what about paying things down through Doge? You talked about that. State fraud, recapture. Fraud recovery is marginal, relative to deficits. I mean, federally, we are talking, tens of trillions of dollars. Okay, this is not going to probably be fixed by even if they can capture billions from each state. It's helpful and it absolutely needs to be solved. It improves optics, but it may not necessarily have a real long-term profound impact on balance sheets. Targeted audits are going to, have high return on investment enforcement and public accountability. But the reality is, in order to do those audits, Kirk, you got to invest in the teams to do it. So going after the money actually has a huge upfront cost of expense in order to be able to enforce them. And unfortunately, again, headline-wise, you get political selectivity and sensitivity. So at the end, if you got to raise your costs to go after more, what kind of net impact do you get? If you automate and you redesign systems, then you can certainly have impact on preventing fraud upstream. You could scale it efficiently, but now you run into job displacement and high upfront cost and labor disruption. So what if we go back and just try to simplify everything? Have fewer loopholes, lower admin cost. Well, then we end up with reduced political leverage. And again, boy, that doesn't go over well when you have these sides that just really want to take each other out. So Fraud recovery, I see it as something that is more impactful of helping trust, but not necessarily solvency. Now let's look at markets. I think it's another one I took notes on. They're priced on expectations. We talked about that. They're not necessarily, they're not based on math. They're based on hope, expectations, narratives, policy assumptions rather than execution. If we allow volatility to occur, and don't control it, that we can restore our price discovery. But the con of that, guess what? It's not comfortable. You can run into a lot of investor panic. You can have sharper corrections. If we reduce forward guidance, we can have less narrative fragility. On the other hand, uncertainty increases and you can have higher risk premiums that come into play. So what about encouraging dispersion? Well, now you can reduce systemic risk, but passive investors get crushed. And that can lead to structural portfolio changes. So, expectation-driven markets are going to be ones that correct fast and hard. There's a couple more, things I've got on here. I mean, tariffs. This is, another one. I mean, obviously using a lot with strategic leverage, but, you run into consumer inflation, you run into retaliation risk. You can have subsidies domestically, which they've been doing in farming and green energy for a long time, which can protect an industry, but that's costly. There's budget strain, there's market distortion, and ultimately controlling cost. These kind of things can control costs more than efficiency. The last couple, that are tied together, government policy. We're looking at policy volatility. It's permanent. It's not going away. So we can have guardrails that increase stability, but we can also limit our flexibility and create political resistance. You've got, if we try to simplify regulations, then we can have lower compliance costs. Businesses love that. But then you're going to start seeing more losers emerge. And we kind of saw that a little bit, again, going back to the airline industry in the 80s. And then you could get into lobbying issues. And all of a sudden, uncertainty becomes a priced asset. If we go to foreign policy like Denmark and Greenland and things like that, now we're focusing on security outweighing efficiency. When we look at alliances, we have this shared burden. If we look at it on the other side of it, we have this dependency and we have this reduced sovereignty, which is something that is very much a position that they're taking right now with the current administration. If we focus on domestic extraction, we end up with control, but now we could have higher costs. We could have inflationary inflationary pressure. And, if we want to have more security for our country, that's going to have an inflation premium. Well, that's part of the rhetoric that's going on there right now is, again, we're looking at the protection and, the rhetoric, Russia and in the Arctic positioning and who's controlling that and what's the cost of controlling that. And I think that lastly, the thing that I'm going to go into is where does this go into? And it really comes down to political. It's all political. It's always political. And we got the midterms coming up. We got Gen Z having a lot of influence now. Policy is always going to be election driven. Gen Z's pressure there is going to accelerate intervention. So we look at real options. If we redistribute, which is certainly in the news, great. Pros are the stability, but on the other hand, we have resentment, and ultimately a major repercussion of that is you just start to see capital fly. If we have public expansion, which we saw a lot of over the last couple of years, we get employment support, but now you're putting pressure and crowding out private sector. You're having potentially long-term impact on productivity. And, now you run into, the key of how do we get political stability? Well, that's purchased financially, but yet we've got all these debts. So you've got this revolving circle of issues, Kirk, that are all intertwined like this. There's different kind of webs, right? You've got orb weaver spiders out there, beautiful webs, very well structurally designed, ornate architecture. And then you got the black widow that lives in a cobweb. It's a massive webs going in all different directions. And to a degree, what we're dealing with here is a little bit of both. They're trying to make it look like this beautiful orb with the dew and the rainbows and the sunlight. But at the end of the day, you've got a mass of webbing that right in the middle is this spider that can have a pretty powerful.
Yeah. So I want to get into some I don't want to say statistics, some metrics here, because as we kind of get close to wrapping up this month, I want to talk a little bit. This month's been crazy in a good way, assuming you were following some of the stuff we said. So I want to go over some things just to keep in mind. So the first one is monthly seasonality. January, December are typically great months. February, not so much. And February, the average return is not terrible because it usually is a February dip, followed by a rebound. So it's not usually like September where you have some crashes in there, which can get a little crazy. But February is typically not a great month. And given the fact that we've had such a great January so far, just cuckoo for January. If you're in some of the metals, you're up double digits in 1 month, and you almost want to just like cash it in and say, all right, I'm done for the year. But February's coming up, and you should expect that maybe things don't always go as planned in February. I also want to point out some things. These are basically sector weights in the S&P 500. I'm not going to spend a lot of time on this, but I did want to point out the fact that technology is a huge part of this. And the smallest one, energy. Energy is 3% of the S&P 500. 3% for something that everybody needs. Without energy, we don't have lights on. We don't have computers, right? And it's only 3% of the S&P. There's reasons for that, but you should just keep that in mind. I think energy might start to break out this year. I'm not sure I'm seeing it yet. And frankly, if Trump is suppressing the price of oil, then it may not, but just something to keep in mind. I'm watching it like a hawk. I'm not sure that it'll be low through the entire election, but I think for at least part of the year, it's going to remain low, which should help earnings. But that being said, I'm watching it like a hawk. I'm not convinced yet it's breaking out, but we're starting to see some signs. Here's the performance as of last weekend. I just saw this and I was like, oh, this is pretty good. You could just kind of see certain areas that things are doing well. Small cap, mid cap have done well so far. I mean, mid cap, small cap up 6-7%, and this is in the first 2 weeks. This isn't even in the third week. They're up even more. Gold, silver's up 25% in the first 2 weeks of the year. That's a little crazy. And so, if you're kind of looking through this, energy, consumer staples, industrials, materials, Mexico, Japan, Israel, emerging markets. Okay. So I point this out, not that, these are special, but if you look at the first 2 weeks of the year, what typically happens is people are rebalancing their portfolios based on what they expect for the year. It's just kind of like when Trump got elected, right? He gets elected. What are the best performing assets? Financials, technology, and materials wasn't up there yet, but financials did really well. You know what? Financials did really well last year. So go figure. I think as you're looking, you look at, it was up 14%, not the gangbuster. Industrial is actually up after he got elected too. I shouldn't say they definitely did well, but the best performers did well, like in the first day after we found the results out. So the first 2 weeks, what are the best performers? Well, probably the ones that are going to be good performers this year. So you might want to mark this. It doesn't mean this is a guarantee that things are going to do this. Is not what I'm saying. I'm saying these are things you should watch for. Look at these areas, put them on a watch list if you weren't before, and say, oh, I wasn't thinking of that. Let me look at this. That's how I look at things like this. It's on a watch list, right? Kind of like if you do something weird, you're on a watch list. Here's a Magnificent Seven this year. Not very good. Not very good at all. You have, out of the 7, you got 5 of them that are negative when the whole market's up virtually. Look at this. What is actually down this year? I can't even, short-term treasuries is down, and natural gas and, communications. Pretty much nothing is down. India, Euro. Nothing's down, right? Everything's up. And yet the big Mag 7 that have been leading it all for years, they're down by quite a bit in the first 2 weeks. What should that tell you? maybe things are changing. Times are changing. We are rotating. I know a lot of people kind of have had a framework for the last 15 years of it's risk on or risk off. It's Mag 7 or nothing. It's Mag 7 or defensive. We're actually in a rotational economy right now. And if you don't know anything about rotational investing, right, because it hasn't been in favor for like over a decade. There was a time where investing in like rotating sectors was a normal way to invest, right? Times are good, you rotate to certain sectors. Times are bad, you rotate to other ones. That's the way things worked. Not anymore. Mag 7 or bust. So you might want to reconsider the fact that you're Mag 7 or bust, because you're going to miss, if you're not in Mag 7 right now and you're in cash because you're waiting for them to rebound, you might miss the bull market going on in everything else. So I only point this out just to prove my point of what I said before, is that when you're in a different frame, the performance changes. Now, granted, these are all expensive, but still, everything else is doing well. Why wouldn't these do well? Well, it's because money is flowing out of these areas and into other areas. International, there were economies that did 40% last year. The S&P didn't even do 20. So it did 17. Things did more than double. And many international markets did better than the US. So you had commodities do great. So if that's happening, why are you continuing to invest in things that are out of favor? Well, it's probably because you've been in the habit of doing it and they've treated you so well. So if that's the case, you one of the biggest challenges in investing is saying, how do I know when I'm wrong? It's really the hardest thing you could do. How do I know when I'm wrong? And am I willing to admit that I'm wrong? I've talked to a lot of people that are like, well, I've been in Apple forever and it's been treating me well, so I'm going to stay in it. That's dumb. Like, I get it. I'm not saying they're dumb. I'm saying the thinking is dumb, because you're basically closed-minded to the fact that things can change. We all do this, right? It's not to that person or people. Everyone does this. I do this, right? It's called fixed mindset. You're unwilling to change your opinion. And that can harm you when it comes to investing. You need to be open-minded about the fact that the markets can change. And right now they are. Here's some other ones. Here are the indexes. Year to date, best performers, micro cap and small cap are the best performers this year, right? S&P 500 is up 1.43. Russell 2000 just shy of 8%. Maybe you want to check out another area. I don't know. Maybe you should open your eyes to other opportunities that are out there. So for all of those of you who had a thing and you did that thing for a long time and it worked, go back and reassess. We talked about this in December. Go back and reassess everything. Reassess what you should be doing, how things work. Reassess what's working, not, and whether you should sell or keep it. And the last one, this is just like sectors and industries. I mean, alternative energy, oil service, 15% in 2 weeks. Aerospace defense, gold miners, nuclear, home builders. All these things are up double digits. Basic materials, semiconductors, double digits in 2 weeks. And so, what are you in? Are you in these things, or are you in financials, healthcare, technology that are doing crickets? So I just want you all to keep this in mind. Lastly, this is the NASDAQ. Tends to do a little bit better in February than the S&P, but not a lot better. So I want you all to start thinking about what this means for your portfolio. Are you in line with what the market is doing? Or are you trying to move the market by saying, this is what I do, I'm just going to wait until it, or you try to will the market to do your wishes? Believe me, I've tried. The market does not go where I want it to go, okay? You have to follow the market. It doesn't follow you. The next week, we're going to go over some of the bonds, the trends in bonds, because there's actually a lot of crazy stuff going on in bonds, and we want to keep track of that, because that will also dictate what happens with stocks. So, Doug, we're at 2:00 here. You want to wrap it up? Take us home.
Well, for those of you that aren't on the East Coast, it's not 2:00; it's 1:00. But I will say this:
we're all on the East Coast, Doug. That's the only time zone that matters.
Well, yes, exactly. So for the rest of you, I guess we don't.
Center of the world, Doug.
Hey, here's the one thing you just touched on bonds that I think is really important is, and we're not going to get into it deeply, but watch Japan. There's
watch Japan. That's why we're waiting until next week. It's too big of a topic.
It is too big of a topic, but for those of you that want to do advanced research, watch Japan. It does not get enough of a look, and we'll just leave it at that. I'm going to just come out and finish out today. If I was going to summarize it, I would say structure going forward is absolutely going to beat the status quo. When you take a step back and you look at this environment, one thing is very clear. It is not just a challenge for the average households anymore. In many ways, it can actually be more dangerous for the affluent and wealthy. Things are more expensive to begin with generally, and there's a lot less there at the bottom available to hold you up. And this is especially going to be true for those born after the start of Gen X and into the older millennial years. And for context, that's going to be around the mid 60s through the mid 80s. That 20-year window is really highly impacted because this is the group that is now looking right on the cusp of some of the highest earning years, peak earning years, but also in this pressure point of the cycle, peak responsibility, peak exposure, aging parents, kids heading into or out of college. You've got mortgages, businesses, equity compensation. You've got concentrated portfolios. Listen, unlike any earlier generations, you really don't have the luxury of time to recover from those major mistakes, but you still have too much runway left to gamble with income. And for years, passive investing did work because there was a narrow group of stocks that carried the market. But we're now in a rotational economy. Capital is moving, leadership is changing. The bull market is no longer just going to be the Mag 7 most likely going forward. Again, that's what it looks like. And it's also not evenly distributed. Ownership without intention, that is becoming a greater increasing liability. And the data absolutely confirms this. So when you run a full analysis, and I'm going to use one methodology, Fama French, and you look at that in the S&P 500, and I talked about this a couple weeks ago, starting in 2000, most portfolios didn't actually fail because the returns were poor. They failed because they ran out of money under traditional assumptions. Again, under that methodology, they ran out as early as 2018. Even a classic 60-40 portfolio nearly broke and would have very little left today under real world sequencing risk, real world inflation and income demands. And it wasn't conservative or flexible enough when protection mattered. And it wasn't able to adapt when markets rotated. And that's going to end up being the real risk right now for anyone listening. It's wealth without structure. And this is why, more than anything, you need to have clarity more than performance. Before returns, before predictions, before headlines, you're going to need to clearly see how your financial life is going to fit together. That means looking at income sources, growth assets, protection assets, taxes, college obligations, and legacy goals. All of it together, one picture. Because without that clarity, you're literally just managing accounts. You're not managing any outcomes. And from there, income planning is going to need guardrails, not just projections. Knowing when capital must be protected, what can rotate within the markets, and what cannot be exposed to bad timing. That's how you're going to avoid setting and selling at the wrong moment, or sacrificing future incomes to solve a short-term problem that is going to inevitably happen. So asset rotation is going to matter more than asset selection during this kind of economy and this time in your life. It's not chasing what's hot, but it's deliberately positioning as these regimes change. And that's how you're going to move away from blind passive exposure without trying to actually outsmart the market, which is impossible. So for those born in this window, more than anyone else, look at your date of birth. This phase isn't about swinging for the fences. It's not going to be about what can I make in the markets. It's going to be about making sure that wealth is going to actually last, that income holds up under stress, and that options stay open. It's going to be important no matter what the markets are, whatever inflation is, whatever policymakers do next. Markets are going to rotate. Old assumptions are going to break. And plans with structure and guardrails are going to endure. Smart money families don't hope, they plan for it. And if you want to learn more about the process to put all that together with intelligent simplicity, check out our website at mergentadvisors.net. That's MERGENT. MERGENT, mergentadvisors.net. And look forward to answering any questions that you might have when you start to look at how there might be gaps in that for you.
Awesome. Well, thanks for joining us, Doug.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.